Hello and welcome. The purpose of this video is to go over Chapter 3 of our Accounting for A course. Starting off by discussing the accounting period, we can break down the accounting period a few different ways. There are 4 quarters in 1 year, so you have quarterly periods. Of course, you have 12 months in a year, and it can be broken down monthly as well. Semi-annually would be 2 accounting periods in 1 year. And then finally, you have the annual accounting period, which is, of course, the calendar year. In this chapter, we will be discussing accrual and cash basis accounting. Now, this is a very important topic. The accrual basis of accounting is when revenues are recorded when products or services are delivered and records expenses when incurred. So please take note here under the accrual basis, cash is not required to exchange hands. So let's say you have a customer that owes you money. You completed, maybe you delivered a product, and your customer has not yet paid you. Under the accrual basis of accounting, you are allowed to report that revenue, even though you haven't received cash just yet. Same with expenses. Let's say you incurred the expense already, but maybe you haven't paid your vendor. Maybe they gave you up until 30 days to pay. Um, so in that case, you would accrue the expense because you used up the expense already. The cash basis of accounting is different. Revenues are recorded when cash is received and expenses are recorded when cash is paid. So under the cash basis, cash needs to exchange hands for revenues or expenses to be recorded. Now, the revenue recognition principle requires that revenue be recorded when goods or services are provided to customers and at an amount expected to be received from customers. The expense recognition principle requires that expenses be recorded in the same accounting period as the revenues that are recognized as a result of those expenses. This matching of expenses with the revenue benefits is a major part of the adjusting process. Now, there are 4 types of adjustments for transactions that extend over more than one period. And we'll go over each of them down the road. But for now, you need to know that our adjustments are made using a 3-step process. Step 1 would be to determine what the current account balance equals. Step 2 would be to determine what the current account balance should equal. And step 3 would be to record an adjusting entry to get from step 1 to step 2. And this will be better explained with an example. Okay, so let's discuss the types of adjusting entries. We have deferrals. We have prepaid expenses, which are expenses paid in cash and recorded as assets before they are used or consumed. So if you prepaid something, while it is an expense, you have not yet accrued the expense. So that it would then be considered an asset, and assets go on your balance sheet. Okay. You have unearned revenues. This is when cash is received and recorded as liabilities before revenue is earned. So maybe you got a cash advance from a customer and you haven't provided your service just yet. In that case, that would be considered an unearned revenue because you have not yet earned it. That would be considered a liability on your balance sheet. Okay, next we have accrued revenues, revenues that are earned but not yet received in cash or recorded. Next, we have accrued expenses. These are expenses incurred but not yet paid in cash or recorded. So to go over prepaid or deferred expenses, prepaid expenses are assets paid for in advance of receiving their benefits. So items like prepaid insurance, prepaid rent, prepaid supplies. So in adjusting for prepaid insurance, step one would be to determine the current balance. Fast Forward paid 2,400 to cover insurance for 24 months that began on December 1st, 2021. Fast Forward then records the expenditure as prepaid insurance on December 1st. So $2,400 was paid up front that has not yet been accrued for. So step two would be to determine what the account balance should equal. Towards the end of December, now 1 month of this prepaid insurance policy has been used, or $100. So you get $100 by taking the 2,400 that was paid for up front, divided by 24 months. That means $100 of insurance is used up each month. From December 1st to December 31st, 100 for $100 of 1 month's worth of insurance has expired. So that means that you no longer have $2,400 in your prepaid insurance account. You have now used up $100. So your adjusting journal entry, and the main purpose of this chapter would be to debit insurance expense. Your expenses went up because you finally used up the expense, and you would credit or decrease your prepaid insurance. Now, step three, the balance sheet will show $2,300 of prepaid insurance remaining. You adjust your totals for the amount that you have since used up. Now, please take note of how prepaid insurance, again, is an asset and it goes on our balance sheet. And insurance expense, once we actually used up the expense, goes on our income statement. This is very important. So after our adjustments, here are some nice T accounts that show you how we account for things. So on December 1st, you started off with 2,400 of prepaid insurance. You used up 100. Now your net balance is 2,300. The journal entry to record this would be to debit insurance expense, which you can see here, we debited insurance expense in our T account. We move that down here. Next, you would credit prepaid insurance to bring the prepaid insurance down, to bring the balance down. Okay, next we have another example with supplies. Step one, fast forward purchase $9,720 of supplies in December. Some of these supplies were used during September. Step two, a physical count of the supplies that was performed on 12/31 shows that unused supplies balance equals 8,670. Okay. So we started off with 9,720. We know we ended with 8,670. So the difference of those two numbers is 1,050. That is the amount for our adjustment. Okay, so we are going to adjust our balances by crediting the supplies account, which is an asset on the balance sheet, right? We need to bring our asset balance down because we used up some of the supplies. And we are going to debit supplies expense. That goes on our income statement because we have used the supplies. Oops, excuse me. So after our adjustment, we have only $8,670 of supplies remaining, the amount from step two. The income statement will show $1,050 worth of supplies expense. So now we've seen the adjustment on T accounts, but we also need to record the adjustments in the general journal, right? We need to record adjusting journal entries here. So same as we have seen, you debit the supplies expense account from here, from this T account. This is a debit. We debit it and bring it down here. Next, we need to credit the supplies account to record supplies that are used. Now we have everyone's favorite topic, depreciation. So instead of expensing the cost of a plant asset, like equipment, buildings, cars, etc., in the year it is purchased, we allocate or spread out the cost over their expected useful lives. This is called depreciation. Now, I like to give a car example here. So let's say you bought a brand new $100,000 car in the current year. Let's say you have a business. Now, should you be allowed to expense $100,000 that year for that car? So think about this. Will a car only last you a full year? Probably not, right? So instead of expensing a huge amount in year one, we're going to spread out that cost of that vehicle over its useful life. Depending on how long the vehicle lasts you, 5 to 7 years. This is called depreciation. We allocate or spread out the cost, in this case of the car, over their expected useful lives. There is a formula for straight line depreciation. This is asset cost minus, excuse me, salvage value divided by the useful life. Now, don't worry. If these words sound a little scary, we will go over them. So, the asset cost is the cost that you purchased the item for. In our example, you purchased the car for $100,000. That would be your asset cost. Your salvage value, and we will discuss this down the line, your salvage value is the value that your vehicle or your asset will have at the end of its useful life. So let's say when you sell and when you're done using your $100,000 car over 5 to 7 years, let's say you expect that you can sell that car for $10,000. That would be your salvage value. That would be an ending value. And the useful life would obviously be the useful life of the asset, usually in years. So in our example, we said a car would last us 3, 5 to 7 years. That would be your useful life. Okay, so fast forward purchase equipment for $26,000 on December 1st. It has an estimated useful life of 5 years. The equipment is expected to be worth about $8,000 at the end of 5 years. This is your salvage value. And you know that they purchased the equipment on December 1st, but it is now December 31st. Because Fast Forward expects the equipment to be worth $8,000 when the 5 years are over, only $18,000 of the cost will be spread over the next 5 years or 60 months. So using our straight line depreciation formula, we know our cost was $26,000. We subtract our salvage value, what we expect the asset to be worth at the end of its useful life. That gives us something called net cost. Your net cost is the amount that you are going to depreciate. You do not include salvage value. That's why we subtract it from the cost value. Okay, so you know that the equipment has a useful life of 5 years. The equipment is expected to be worth 8 grand at the end of the 5 years. Fast forward is using straight line depreciation. So you take your cost minus salvage value, 26,000 minus 8,000, that gives you 18,000. 18,000 of the cost needs to be spread over the next 60 months. So 1 month would be 18,000 divided by 60 months gives you your monthly depreciation. Now we got 60 from the 5 years. And of course, you know that there are 12 months in a year. So it's 5 times 12 equals 60 over 60 months. This 300 is your monthly depreciation. Okay, now for the adjusting entry, taken into account our T accounts. Of course, you know, we record the debit in our equipment when we purchased it on December 1st. You have depreciation expense that will be debited for 300 and something called accumulated depreciation that is credited for $300. Now we will go over this down the line, but for now you need to know that accumulated depreciation is a contra asset account. It brings down the asset value of your asset on your balance sheet. And again, we'll go over this. So you record the adjusting entry for $300 for 1 month. The depreciation amount of $300 is credited to the accumulated depreciation account instead of the asset account. Okay. So here is your adjusting entry. You debit the depreciation expense that goes on your income statement and you credit accumulated depreciation equipment for $300. Now the accumulated depreciation goes on your balance sheet under assets, although it is a contra asset account. So what does a contra asset account mean? So better explained with an example, right? So we recorded our equipment and we also need to back out accumulated depreciation that we have recorded to date. Now, what does this do? As you can see, we subtract accumulated depreciation from the asset cost, and that gives you something called book value. So in this case, it would be $25,100. You subtract the accumulated depreciation from the equipment cost, or you can list it out this way, which is actually preferred, but you can also just record equipment net as it's done here. So after 3 months of depreciation have been taken, the equipment is shown at its $25,100 book value or net of accumulated depreciation. So now we are going to go over the deferral of revenue. We have something called unearned revenue, which I have explained earlier in this video, is cash received in advance of providing products or services. Now we need to make adjustments for these unearned revenues because although you might have received cash up front, you're going to earn that money once you complete the service. So that is why we need an adjusting journal entry. For an example, we have Fast Forward's client paid a 60-day fee in advance covering the period from 12/27 to 2/24, and they recorded a debit to cash, making their cash balance go up, and a credit to unearned consulting revenue, which is a liability. A credit to a liability makes the liability balance go up. So step 2, Fast Forward earns payment as time passes. At 12/31, 5 days of service is earned, right? Because the period is 12/27. and it is now 12/31, so 5 days of service revenues earned. You take 5 divided by 60, you get the 60 from up here. You multiply that by the $3,000, and that gives you the amount that Fast Forward has now earned. Step 3 would be is adjusting entry reduces liability unearned consulting revenue by 250 for 5 days of revenue. Now, why do we need to decrease the liability for this amount? Well, because unearned revenue is a liability account for monies that you have not earned. And now, after 5 days of performing services, you have now earned $250. So we need to record an adjusting entry for consulting revenue of $250 that is earned. Okay, so breaking this down into T accounts, you started off with $3,000 in unearned revenue on 12/26. You record a debit for $250 for the amount that has been earned, and that gives you the net amount of $2,750. That is on your balance sheet. Okay, so the income statement will show $6,050 of consulting revenue earned. As you can see here, we included the $250. Revenue has a normal credit balance, so $250 makes your revenue go up on your income statement. Okay, now we record the actual adjusting journal entry. You debit unearned revenue for $250, reducing your liability because you have now earned that money, and you credit your actual revenue on your income statement to make your revenue go up. Now going over accrued expenses. Accrued expenses are costs incurred in a period that are both unpaid and unrecorded. Now let's go over an accrued salaries example. Fast Forward pays its employees $70 a day or $350 for a 5-day work week. Salaries are paid every 2 weeks on a Friday. 12/31 is a Wednesday. So 3 days salaries are owed at year end, which equals $70 times 3 equals 210. Okay. Step 3, adjusting entry increases a liability, salaries payable, that is a liability, and it increases your salaries expense for $210 with the following entry. You debit salaries expense to make your expense balance go up because expenses have a normal debit balance. Then you record a credit to salaries payable, a liability, which makes your liability go up for $210 to record 3 days of accrued salaries. Again, because year end 12/31, our accounting period, it ends on a Wednesday. So we have to pay our employees for Monday, Tuesday, and Wednesday of that week. Okay, now just breaking it down into T accounts. The balance sheet will show $210 of salaries payable owed. And the income statement will show $1,610 of total salaries expense. We include the $210 here as a debit. Now we have future cash payment of accrued expenses because you're going to get around to paying these, right? So accrued expenses at the end of one period results in a cash payment in a future period. So on 12/31, Fast Forward recorded accrued salaries of 210. Now on January 9th of the next year, the following entry will reduce the accrued liability, salaries payable, and record the expense for 7 days of work in January. Now, this is where a lot of students get lost, so please take your time with this. We are debiting salaries payable for 210 because we are getting rid of the liability. At 12/31, we said, hey, we owe our employees $210. Well, now that it's January 9th and you're about to pay them their paychecks, you are going to get rid of this liability because now you are saying, hey, I no longer owe my employees this money. I am paying them now. You are going to debit salaries expense 7 times 70. Now, we get the 7 from the 7 days of work in January. Okay, so these are the amounts that we are paying our employees from January 1st up until January 9th. And we credit cash for $700, which is our 210 plus our 490, right? So we're paying them for amounts we owed them at the end of December and the amounts that they have worked in January. We are paying them the full amount here. Okay. Now, accrued revenues. Accrued revenues are revenues earned in a period that are both unrecorded and not yet received in cash or other assets. So for an example, on 12/12, Fast Forward's customers agreed to pay $2,700 on January 10th of the next year for future services over the next 30 days. On 12/31, 20 days worth of services have been provided and earned, which totals $1,800. That is 2,700 times 20 divided by 30 days. An adjusting entry increases an asset, accounts receivable, and it increases consulting revenue for $1,800 with the following entry. Accounts receivable is an asset. These are amounts that clients owe you after you have performed services. So you debit AR, that is what we call it. We abbreviate it. You debit AR for $1,800 and you credit consulting revenue for $1,800 to record 20 days of accrued revenues. Okay, so here showing items in our T account. Your AR has $1,800 as a balance. And you also go ahead and record the revenue for $1,800. Now the income statement will show $7,850 total consulting revenue. Now, of course, you will eventually receive cash. Accrued revenue at the end of one period results in a cash receipt in a future period, right? Because you expect your customers to pay you at some point. So on 12/31, Fast Forward recorded accrued revenue earned of $1,800. On January 10th of the next year, the following entry will reduce accounts receivable for 10 days and receipt of $2,700 cash. You debit cash for the amount that you received. You credit AR because you are saying that your customers have just paid you. They no longer owe you this amount. So that is why you are crediting your AR. You are making your balance go down because we recorded 1,800 in the past. And now you are going to credit consulting revenue for 10 days of service worked on up until January 1st until January 10th. Okay. Here is a nice summary of a link to financial statements. This will be tested, so please take your time with this slide. This might be 2, maybe 3 questions on your upcoming exam. Okay, we are going to go over steps for preparing financial statements from an unadjusted trial balance. Step 1 would be to prepare the income statement using revenue and expense accounts accounts from adjusted trial balance. Step 2 would be to prepare the statement of retained earnings using retained earnings and dividends from the trial balance and pull net income from step 1. Step 3 would be to prepare balance sheet using asset and liability accounts along with common stock from trial balance and pull updated retained earnings balance from step 2. Step 4 would be to prepare statement of cash flows from changes in cash flows for the period illustrated a little later. So here is a nice visual that you have seen before that explains how we prepare financial statements from our adjusted trial balance. Okay, so as you can see, these amounts in our trial balance flow through to our financials. Okay, now we are going to go over something called the closing process. Now, in our worksheets, we have a nice acronym to remember this and to remember the order in which we close our books. So, the closing process resets revenue, expense, and the dividends account balances to zero at the end of the period. Step 2, it updates retained earnings account to match that reported in the balance sheet and the statement of retained earnings. So why is it important to close revenue and expenses at the end of a period? So think about it. Let's say we have January 1st up until December 31st of 2024 as our accounting period. It's important to close that entire year. We're going to close our revenues and expenses so that in 2025, we don't see 2024 revenues on our books. So think about this as a business owner. You want your accounting data broken out into useful information that you can use to make better decisions, right? So if you're looking and you're trying to find out how you're doing in 2025, do you really need to see 2024's info clumped with 2025? No, of course not. So that is why it is important to close our accounts at the end of the period. So we have something called temporary and permanent accounts. The closing process only applies to our temporary accounts. These are our revenues, expenses, dividends, and our income summary. Our permanent accounts are not closed at period end. These are our assets, liabilities, common stock, and retained earnings. So think about this. We have cash as an asset. Why wouldn't we close out cash at the end of the year? So at 12:31, when you're at a New Year's Eve get-together party and it's about to strike midnight, let's say you have $10,000 in your bank account, right? Now all of a sudden it's January 1st, early in the morning, it's 1 a.m. Do you still have $10,000 in your bank account? Yeah, of course you do, right? Money just doesn't disappear because we enter a new accounting period. So that is why cash, assets, liabilities, common stock, and retained earnings are called permanent accounts. We do not close them at the end of the year. They don't just disappear because we started a new year. Okay, so recording closing entries. This is a very important slide. You have to close these out in this order on your homework. Otherwise, it'll be wrong. So step 1 would be to close credit balances. Oops, excuse me. This first step would be to close credit balances in revenue accounts to the income summary. Next, we will close our debit balances in our expense accounts to the income summary. Step 3 would be to close the income summary account to retained earnings. And step 4 would be to close dividends to retained earnings. Okay, so this is also a nice visual. First, we are going to close our revenues, right? So here we have our revenue accounts. you go ahead and debit the amounts in your revenue to bring it down to zero. So revenue has a normal credit balance. You're going to debit it to bring it to zero, and you're going to credit the income summary. Okay. Next, you are going to adjust your expense accounts. You know that expenses have a normal debit balance. You are going to credit them to bring them to zero, and you are going to debit the full amount to the income summary. Okay, and then you do the same for retained earnings and dividends. So you have something called a post-closing trial balance. It's a list of permanent accounts and their balances after posting closing entries. The total debits and credits must be equal, and all temporary accounts have a zero balance. So here is a quick example. We can pause here. Okay, so now we are going to go over something called a classified balance sheet. So current items, so we list out items on our balance sheet in under current items or non-current or long-term items. Okay, so we have current items that are expected to come due within the longer of 1 year or the company's normal operating cycle. So you have your current assets and your current liabilities. Most operating cycles are less than 1 year, so most companies use a 1 year period in deciding what assets and liabilities are current. Okay, so your current assets are items that are considered to be quick to convert to cash. That is why they are called current. Okay, so a classified balance sheet is important because it lists out items in order of liquidity. Again, here in your current assets, these are items that are expected to be quickly convertible to cash if needed. Okay, you have your long-term investments, and then you have your plant assets and your intangible assets. Next, you have your current liabilities and your long-term liabilities. And finally, we have equity. Okay, so special attention to our liabilities now. You have accounts payable, wages payable, and unearned revenue that are expected to be paid off in the near future. But conversely, you have something called long-term liabilities that are going to take a little bit longer to pay off. So you have something called a note payable that is due in 10 years. Maybe you also have something called mortgage payable, right? Think about it that way. If you have a mortgage on your home, it's going to take you a long time to pay off your home, right? That would be considered a long-term liability. That's another good example. Okay, going into detail of all of these a little bit further, we have something called current assets. Current assets are expected to be sold, collected, or used within 1 year. Some examples are cash, short-term investments, accounts receivable, short-term notes receivable, merchandise inventory, and prepaid expenses. Long-term investments are expected to be held for more than 1 year or the operating cycle. We have items like notes receivable, investments in stocks and bonds, expected to be held for more than the longer of 1 year or the operating cycle. So these are just investments that the company owns. These are assets. Next, you have plant assets. Those are tangible, long-lived assets used to produce or sell products and services. Now we depreciate most plant assets. Examples include equipment, machinery, buildings, and land that are used to sell products and services. We also call these PP&E, that stands for property, plant, and equipment, or fixed assets. Intangible assets are long-term assets that benefit business operation but lack physical form. Now, we will learn about this further on in this course, so don't worry too much about these just now. Current liabilities are liabilities due within the longer of 1 year or the company's operating cycle. Examples include accounts payable, wages payable, taxes payable, interest payable, and unearned revenues. Okay, these are amounts that the company owes. These are liabilities. Long-term liabilities are liabilities not due within the longer of 1 year or the company's operating cycle. We have notes payable. Again, mortgages payable is the one that probably relates more to your personal life. Bonds payable and lease obligations. Finally, we have equity. This is where a lot of students tend to get confused. Equity is the owner's claim on the company's assets. For a corporation, these are reported in retained earnings and common stock accounts. Equity is not separated into current and non-current categories. Okay, lastly, we have a few ratios to go over. We have the profit margin ratio. Now, this is a ratio that measures the company's net income to net sales. Okay, so we're going to take our net income and divide it by your net sales, and that gives you your profit margin. That gives you a percentage that can help you analyze, again, your company's profitability. Next, you have the current ratio. This ratio helps assess the company's ability to pay its debts in the near future. So you take your current assets and divide it by your current liability. This will give you a ratio that helps you determine, again, how you are able to pay your debts in the near future. So if you look at this example, we have current assets of 23,485, but you have current liabilities of 23,237. So you are just barely able to cover all of your current liabilities with your current assets. That gives you a ratio of 1.01. When you have a ratio of less than 1.0, that tells you that you have more liabilities than you do assets to pay off those liabilities. I hope you found this video helpful, and as always, please feel to email me if you have any questions. Good luck.